In 2015, Michael Dell sat across from the board of EMC with a $67 billion proposal. There was just one problem. Dell didn't have the money. In fact, he was already drowning in $24 billion of debt from taking his own company private 2 years earlier. To the bulge bracket banks, this deal looked radioactive, but to the equity markets, EMC's legacy storage business was a melting ice cube. Yet, 12 months later, the deal was closed. Now, this wasn't solved by a bigger loan, it was solved by a piece of financial architecture that should not have existed. This is the story of how private credit and synthetic stock created the largest tech merger in history. To understand the deal, you have to understand the hostage situation. EMC owned 80% of VMware, the software giant powering the world's cloud at the time. VMware was the crown jewel, but it was trapped inside EMC's sluggish hardware business. Michael Dell wanted VMware, but if he paid cash for the whole of EMC, the interest payments would have breached every debt covenant he had. He needed to buy the he needed to buy the company without actually paying for all of it. He needed a way to use VMware's value as a currency without selling the asset. This is the edge. Dell and Silver Lake engineered a tracking stock called DVMT. This wasn't a share in Dell and it wasn't a share in VMware. It was a synthetic, an instrument that promised shareholders a return linked to VMware's performance, while Michael Dell kept the actual voting control. By issuing $13 billion of this paper, Dell avoided borrowing $13 billion in cash. He effectively printed his own currency to fund the acquisition, shifting the risk from his balance sheet directly to the EMC shareholders. Even with the tracking stock, the cash hole was $50 billion. The capital stack was a vertical line of risk. At the top, senior secured notes, which were safe and low yield, but the middle, the second lien and mezzanine layers, this is where private credit lived. These lenders weren't looking at collateral, they were looking at the EBITDA to interest coverage. They bet that the combined Dell and EMC cash flow could survive a 5 times leverage ratio. If the cash flow dropped by 20%, these lenders had the covenants to seize the company. They weren't just lending, they were also underwriting the survival of the enterprise. When you carry $50 billion in debt, you aren't running a tech company, you're running a debt repayment utility. Dell implemented a cash sweep. This is a mechanical requirement in the credit agreement where every cent of excess cash flow at the end of every quarter must go to the lenders. You cannot reinvest in research and development and you don't hire. You pay the wig. Michael Dell's gamble was that he could cut $1.7 billion in synergies, mostly through aggressive layoffs and consolidation, which was faster than the interest rates could compound at that time. In 2018, the trap snapped shut. Dell announced he would buy back the DVMT tracking stock to become a public company again. He offered a massive discount to the actual VMware price. Shareholders like Carl Icahn screamed theft, but the math was in Dell's favor. He successfully converted the synthetic stock into real Dell equity at a fraction of its true value. He had used the private credit markets to bridge the gap during the dark years and emerged on the other side owning a $100 billion empire. What most people miss is that the Dell EMC deal wasn't a win for computing. It was a win for structured finance, and private credit acted as the safety valve, providing the flexible capital that the public banks were too regulated to offer. The lesson here is that in high finance, complexity is often a feature and not a bug. If you can't afford the asset, you change the definition of payment. Michael Dell didn't just build a better computer, he built a better balance sheet. If we look at the final cap table, the genius of this deal is visible in the layers. Notice the senior secured tranche at the top. That $13.7 billion was the cheap money, but it was locked down by the most restrictive covenants. Below that, the second lien debt. This is where private credit funds lived, taking a higher risk for a much higher coupon. But the real magic is that tracking stock row. By moving $13.3 billion out of the debt column and into this synthetic equity column, Michael Dell lowered his interest burden just enough to keep the company from suffocating. He didn't find a lender, he engineered an asset class to bridge a $13 billion hole that simply shouldn't have been fillable.